Hi everyone, so today I'm going to do a quick high-level valuation of VIP Shop or VIP Shop based out of China to see whether it's worth spending some serious time researching this company. This company has been brought to my attention by some fantastic subscribers, so thank you for that. Keep them coming. Now, I'm not doing a full analysis here. I don't have the time to seriously analyze like the thousands of companies that are out there. So I'm trying to filter as many of them out as I can using this method. So even if the company does pass or fail this quick valuation, it doesn't make it a good or a bad investment. It's just a way to motivate me whether I want to go onwards and do further research into the company. So just sit back and relax and just follow along with me as best you can. We will have a target buy price by the end of this video. And look, it's part art and part science anyway. And the more practice we do, the better we're going to get. So let's go check it out. Okay, to do this valuation, what I'm going to do is go through my 9-point checklist and then give you my opinion. Okay, so firstly, we have to talk about just what is VIP Shop or VIP Shop. I'm not sure how to say this. I'm just going to call it VIP Shop because it makes sense to me. Okay, VIP Shop, from my very, very basic understanding from like Wikipedia and a quick just Google search, is that they are a discount online retailer out of China. And lots of big brands, you got Adidas and Fila and all the designer brands and stuff like that. When they have too much stuff, like they've made too many of a particular t-shirt or a particular dress or pair of shoes or watches or something, and they want to move inventory, they go to somewhere like VIP Shop, and it's like a discount retailer that they can push out a lot of units quickly, make obviously less margins than they normally would. And that's sort of how they sort of move their inventory and sort of move on to the next thing. VIP Shop is the place that they can sort of dump their stuff. That's my opinion of it so far. I know that JD.com and Tencent also have a stake in this company. So JD, I know that when they have too much inventory, something in their warehouses, they can just send it over to VIP Shop or try to move it through VIP Shop. That's my understanding. It's a pretty interesting business model. Okay, first thing we need to look at is revenue growth for this valuation. And no, look, revenue is obviously the money just coming into the business and selling the products. So I go over to Morningstar and I look at the history of the revenue. And as you can see here, from 26, actually all the way through, it's been growing really strong. 56, 72, 84, 92, 101, and the last trailing 12 months is 111. It's very solid, consistent growth. Fantastic to see. That's definitely a tick. Gross margins. Now, this is the revenue that they're making minus the actual costs of the product itself. So look, if we have a look at their gross margin as a percentage, it was sort of in the mid 20s and now it's sort of in the low 20s. That's actually pretty low. I like to see gross margins above 40%, but this is what a discount retailer is. They're going to keep their margins thin because they're just trying to move huge amounts of product. So for a discount retailer, this is probably fine, but it doesn't make it that good of a business because of this problem. So look, I'm going to give them a cross here. Okay, return on invested capital. This is essentially how well the management are investing money back into the business to keep it growing. If they're doing a good job with this return on invested capital number, it's actually been above 15% for most of it as well. That's actually really strong. I'm happy with that. It means that the money that they're making, they're growing, using that to generate more. So that's good. I'm actually happy with that. I would give that a tick. Debt levels. Now, debt, I hate debt. And we just want to make sure that debt in the short term is manageable. Look, debt is the number one reason why businesses get into any sort of trouble. So the current ratio at the moment is a 1.31. I like to see this normally above a 1.5, but for a low margin business, maybe this is okay. I'm a little bit on the fence with the current ratio here. I'm probably going to give it a tick just because it's that 1.3. It is current. It means current assets are above current liabilities. So right now it's okay. Okay, free cash flow. Let's move on. Is the operating cash minus capital expenditure. And this is essentially the cash coming in from running the business minus all the things needing to keep the business going and all the expansion plans and all that type of stuff. Free cash flow is a really important number, and it's what is essentially returned to us as shareholders. the management actually will use this free cash flow in ways to help the shareholders. So they might pay down their debt, or they might give it a dividend, or there's things they can do. But essentially, this is what our share of the company is this free cash flow. So we want to see this solid and growing. So if I look at the free cash flow, here it is here. Since 2016, well, these years here, there's a few negative years here, but since then, since 2017, it's really turned a bit of a corner here and started to get quite strong. So that's some pretty exceptional free cash flow growth here. I'm pretty happy with that, actually. That's not too bad. All right, before we go on, I use Interactive Brokers and Saxo Bank as my trading platforms. I don't use Robinhood or anything like that, or any of those apps, because they're not reputable, they're not stable, and they don't give me access to the international markets. Interactive Brokers, I think, is the best. It has lower fees than Saxo Bank, but I like to split between the two just to diversify my holdings across the two platforms. And now I do have a link in my description. It is an affiliate link to Interactive Brokers and Saxo Bank. Once you sign up and deposit money into these accounts, for Interactive Brokers, you actually will get $200 worth of free Interactive Brokers stock, which you can sell or do whatever you want with. It's just a gift if you use my affiliate link. So yeah, go ahead and do that if you feel like it. Shares outstanding. Shares outstanding is essentially just the amount of shares that we have available to buy. Now, if this number is getting bigger, it means we're getting diluted, and that's bad. We want our ownership percentage getting stronger, so we want to see this at least stable, or if not, getting the share count actually going down. So for the shares, let's have a look. Since 2016, it was 629 million. It's now 696, so it has gone up. Yeah, we've been getting diluted. It's not crazy dilution, but we are getting diluted. So yeah, that's not good. Okay, insider ownership. Now, I think this is really important because we want the incentives of the people, the CEO and the founders, we want them heavily invested, so their incentives are in line with us as potential shareholders. To check that out, I like to look at Simply Wall Street, and I go right down to the bottom of the page, and it will tell me the leadership team here, and it also tells me their ownership percentage. So we have Ya Shen and, I don't know how to say this name, Xiaobo Hong. That was my best guess. They own nearly 20% of the company, so that's pretty great. Yeah, they own about 18.2% to be exact. That's great. That's more than about 5%, which was what I'd be looking for. So the owners still have big stakes in the company and want the share price to improve. That's perfect. Super investors. Okay. Now, this is really just so we have somebody else who's better than me and smarter than me. They've gone over this company before and they've invested their money. That would give me a lot more conviction. I'm looking to see if any of my favorite investors, my favorite super investors, have invested in this company. And unfortunately, there actually isn't that I could find, except the fact that Tencent and JD, which is just here, are second and third largest shareholders in this company. I have big respect for Tencent. I think their management team are absolutely brilliant, but I don't have any of my super investors invest in this company. This is it's not quite good enough to pass this criteria, but it is still a bit of a positive. This is the most important part of what we're going to do for this valuation. And look, even if this is a great company, but if we overpay for it, it's going to be a bad return on our investment. And at the end of the day, I just want to make money. So I don't care if it's the greatest company of all time. I'm not going to overpay for it. Okay, so let's do that. So we're going to use my intrinsic value calculator. It's free. It's in the description if you want a copy of this yourself. You'll have all the formulas then for yourself. Okay, growth rates. Now, I'm going to have a look here, and the growth rates this is in Morningstar. Now, the growth rates for revenue, the last year was about 10%. The 3-year average is about 10%. The 5-year average is about 20%. And the 10-year average, well, that's probably coming off a really low base. So I'm not going to use the 10-year average here. I'm probably not even going to use the 5-year average. I'm probably looking more at this sort of 10% range. Earnings per share is actually really strong here. That's pretty good. If I look at free cash flow growth, that's been pretty strong as well for the last couple of years. Even though revenue's been growing at 10%, it's probably a little bit closer. We could probably use this free cash flow growth this is a bit tricky. I'm trying to juggle between the earnings per share, the revenue growth, and the free cash flow growth to get a bit of a feel here. I'm going to say, look, the business really can only grow at its revenue plus its return on investment. I'm going to call it 20%. Now, I'm probably going to have to spend some time adjusting that higher and adjusting that lower. Now, this is for the next 5 years, and then the 5 years after that, look, it's too hard to predict. The further out we go, the harder it is to predict. So I'm going to just drop that down to 10%. Okay, my return on investment goal. Now, this is a Chinese company. It's relatively small. Their market cap is 12 billion. Yep, 12 billion. So look, it's a relatively small Chinese company. It's potentially growing kind of quickly. It has some good investors on board. I still need I want a big return on my investment. I'm really actually aiming for about 20%, maybe 25%. That's sort of what I'm gunning for. But putting my discount rate at 30% gives me a margin of safety built in. And the multiple we could sell it for is definitely only about 20. That's a fair multiple of free cash flow. Okay, now we're actually going to we're going to put in the free cash flow. Now, this could be a pandemic related year, so I'm going to prefer to go back to 2019's number, 1.24 in the US dollars. Shares outstanding is, we're going to call that 700 million because we have been getting diluted over the years. So it's probably going to continue being diluted. So it's 0.7 because we've got to keep this in billions since I've started keeping it, having it in billions. Okay, the total cash number is, this is interesting. There's a lot of cash compared to their debt. So they have 18 billion in cash. So 2.78, and their total debt was actually really small, is only 1.67 billion. Okay, and the price that we want to buy this at with these numbers is around about $21 a share. So then I go have a look at the actual share price and, well, here we go. We're about $18 right now. So that's really interesting. Okay, now let me sum all this up by giving you my opinion. Now, we have Tencent and JD are investors, and they can help push the company forward. JD can just keep supplying their overstocked products to VIP Shop, and Tencent can use WeChat to promote the sales. I think that's a really great little partnership between Tencent, JD, and VIP Shop. I really like that. Another positive is that they're still quite small at only $12 billion market cap. The founders still own big parts of the company. The price is actually really attractive, as we just saw. And look, I think the price is low because they're sort of dealing with the same Chinese stigma that like Alibaba and Tencent and everyone else is sort of going through at the moment. It's kind of led us to an interesting opportunity here. But the negatives are that gross margins are declining. Shares outstanding also gives me no confidence that I'm not going to be diluted a lot further in the future. And there aren't any super investors. That would give me so much more conviction on this idea. My overall opinion is that, look, when I think about what discount retail is, it's actually a really tough business and there's no real customer loyalty. I think customers are really just chasing the cheapest prices and they don't really care about if they go to VIP Shop or some other website. I just don't feel like VIP Shop have customer loyalty or any sort of competitive advantage of any kind. I guess the competitive advantage is they've teamed up with Tencent and JD. That's a pretty interesting competitive advantage, but Tencent and JD could go somewhere else, do something else. There could be other companies come in. I'm not really sure about this competitive advantage. Those bad margins really hurt the business. So look, as competition does come in, it will eat at these margins and there's just not much room there for them to move. Look, every business could be a good investment. I think I've decided that if I could get like a silly low price, like $9, actually $10 or something like that. Let's say there's something dramatic that happens in the market in the next sort of 6 to 12 months. If it gets down to like $10, well, my return is then I'm starting to get, look, let's even assume these growth rates get lower. Let's also then go for 50% return on my money. Look, like I said, under about $10, this would potentially give me 50% per annum return on my money. That's extraordinarily attractive, and I think that justifies the risks and those negative points that I've just laid out. So there you go. I hope you enjoyed my VIP Shop stock evaluation for 2021. Let me know your thoughts in the comments. If you have a company you'd like me to look at in the future, please leave it in the comments as well. Hit subscribe before you go, hit the like button before you go, and I'll see you next time.